For author and trading mentor Simon Ree, the signs of a looming recession in 2024 are pretty clear. Loans harder to get and more costly, a slowdown in manufacturing, and job losses amid sluggish economic activity. He says they all point to a slowdown by the first half of next year, and all this even as rates remain high.
The contraction in credit, I think, is a big one. Credit creation is the lifeblood of a credit-based economy like the US. We're also seeing signs of recession in Germany. Japan had a much weaker than expected third quarter GDP. It's now in contraction. China, of course, is facing its own economic woes and a slowdown. And I think the US is probably next. That if you've got sort of those four powerhouse economies in the world all contracting, it's going to be very difficult to avoid a global recession.
Recession may not be as severe as the global financial crisis, but it could be prolonged.
Okay, I think it could go on for several quarters because the fiscal stimulus has already been massive. Since COVID, the US government has spent approximately $5.2 trillion on fiscal stimulus, so they don't have much in the reserve tank to keep spending.
The talk this year was of recession, yet it didn't turn out that way. Equities rallied, but it might be a different story in 2024.
Our sense is that it's still a central scenario, that the recession has been delayed but not removed from the agenda. So we're still going to see that recession coming through in 2024. As an investor, I guess we'd prefer to get that out of the way earlier rather than later, because then I think people could invest with more confidence in the second half of the year once it's out of the way.
As economic prospects dim, the US Federal Reserve's next move will be keenly watched.
I think it's just a matter of time before the Fed cuts interest rates, but they're probably going to want to stay on hold for some time to come. Inflation is coming down, but it's still above where they want it from a target perspective, and clearly that's going to be front and center of their mind. So despite what we're seeing on the economy, they're still very focused on not wanting to ease policy and signal success too early on the inflation front.
With the US Fed's rate hike cycle nearing an end, fixed income could be the outperformer in 2024.
So if Fed funds rates falling, that would generally mean that bond yields are going to fall as well, which means bond prices are rallying. I think equities will probably be flat to down next year. You know, maybe it'll be a down 10, down 15% type year, whereas bonds, you probably earn a positive real return with the yield and potentially some capital growth there as well.
Very high quality fixed income are sitting in the 5, 6, 7% handle. And in this world where fixed income, where coupons are giving you that carry, this is going to be able to ride you through different cycles, right? As long as you have done your homework on understanding about the name, the issuer, you will be guaranteed this level of income, right? As long as you believe the name doesn't default.
In such an environment, many investors will be looking for a defensive approach.
Sectors that are going to do well when leverage is expensive, yields are much higher, they are able to pass through the cost, right? So some firms in the utility space might be able to do that. We think that there are also winners and losers from active fiscal policy. Some of the aerospace, defense company can do fairly well in this scenario. We like companies that are very focused on the inherent long-term structural trends that we see in some of the middle-class countries we see in Asia, whether in Indonesia and India, even in China in terms of digitalization.
Apart from utilities, healthcare could also do well in 2024. But technology, semiconductors and financials will likely underperform.
That 60-40 bond portfolio bond equity portfolio is probably going to do better for investors. The one thing we would say though is if you have access to private assets, that's a great diversifier in a portfolio, whether it be private credit or private real estate. We believe those are good additions to your portfolio as well as equity long short, particularly in Asia.
A very rigorous investment philosophy is sticking to that process. The way we think about portfolio construction doesn't change. How we pick names hasn't really changed. But I think the thinking about what drives the returns is going to change.
For now, the key is to stay invested for the long term.
I really don't care whether the market is rising or falling because I play both bullish and bearish markets. My only care is that my account value increases each month. All right, so I take short-term strategies and I'm just trying to make 5% a month, whether the market's rising or falling. Sometimes that's easy to do in a falling market. My best months typically occur right as a market sell-off is beginning.
The key is not to get excessively scared. We don't know what's going to happen in 2024. Nobody does. But if we just look at it and say, look, we should be buying into assets when they go on sale. I think if you have that mentality and that approach, you'll find 2024 a lot easier to deal with.